Macro Sutra with Radhika Pandey. Exactly 2 years back, during and after the first wave of COVID, the pandemic, cutting interest rates was seen as the solution to the problems the economy had begun to face. 2 years later, increasing interest rates is being seen as the solution to help the economy, which has gone through a lot in the last 2 years. So, how does this cutting rates and increasing rates, and what is the impact of increasing rates on the economy? I mean, if cutting was supposed to help, how is increasing supposed to help now, and what has changed? For that, we have Radhika Pandey to explain to us what's going on with these cycles of rate cuts and rate increases. My first question to you, Radhika, is that 50 basis points, because the governor had said that it's a no-brainer. So we all knew that there is going to be an increase in the key policy rate. Last month, 40 basis points. This month, 50. So is 50 something you expected, or was it a bit of a surprise on the higher side?
So, while the markets were penciling in around 35 to 40 basis points hike, given that the RBI had already raised 40 basis points during the off-cycle meeting, but it was on expected lines given the RBI's communication, because what they have said is that inflation has become more broad-based. There is spillage from input cost pressures to output prices, not only in goods but also in services. So inflationary risks have increased much more than anticipated. So taking all those things into account, I think 50 basis points was on expected line. Another important factor here is that if you look around globally, central banks have been raising rates aggressively. If you look at the US Fed, they have increased rates by 50 basis points in the May meeting, and then again they are expected to raise rates. So to be in line with what other central banks are doing and to reiterate its commitment towards inflation control, given that for some time there was this concern that RBI is falling behind the curve.
Correct.
So I think it was on expected lines that RBI front loads interest rate hikes during the first half of the year itself.
Explain something to me, Radhika, for a lay person. From what we used to generally see in newspaper headlines was 25 basis points, 25. RBI has surprised us earlier also with an unconventional number, which is like a 40.
Yeah.
And this time again they did 40, and during the press conference the governor also talked about 40, but when he said no, I actually mean it's 50, because he also was fumbling, because 40 has become something. So what is this thing about 25, 25, 25, 25, because it makes a whole 100 basis points, but now they also play with 40s and 20s and all of that. So what is is there a formula there, or is it something up to anyone?
I think it's more about their guidance and what they want to say. So if you now look at their policy statements and guidance, they have increasingly used the term called calibrated tightening. So when you talk about calibrated tightening, so then you are not just bound by 25 basis or 50 basis points. You want to experiment with say 35 basis points. In last another episode, the RBI had raised change rates by 35 basis points. So they are trying to do this in a calibrated manner. So I think that is where it comes from, because conventionally earlier it was either 25 basis points or 50 basis points. But now that things have become so uncertain and inflationary pressures are emerging from a number of sources, and they want to do it in a calibrated manner. So I think that is where it's coming from, these unconventional percentage hikes.
So those unconventional 10 basis points, do they make a difference?
They do make a difference, particularly now on the lending rates, if you see, especially because now most of the banks have moved to what is called MCLR, which is marginal cost-based funding, where interest rates, particularly for home loans, personal loans, also for small enterprises, are linked to the repo rate. So whenever the repo rate is changed, you see an automatic increase, at least on the lending side. And that's what we've been seeing, in May, when RBI raised interest rate, we saw immediate hikes by banks. On 8th, RBI raised 50 basis points. Again, HDFC and other private banks have raised rates. So at least on the lending side, we are now seeing a very quick transmission, not on the deposit side.
Tell me all about it, because this is a very sore point you have touched on. When the rates go up, you get a mail within 2-3 days saying your EMI has been adjusted in this way, so your principal goes down this much and your interest rate goes up. And so I have got 2 mails in 2 months. But when the rates are cut, you have to go there and give them a check to be able to get the rates to be reduced. So it's a very unfair system, but that is the system we are living with. Hopefully it will get better. So anyway, let us come back to the point. This whole 50 basis point increase, Radhika, because inflation has been the key problem which RBI is trying to address with these rate hikes. And you have mentioned in your column today, Macro Sutra, which is, the link will be in the notes of this show, that there are greater pass-through of input costs also now, and that is, worsening inflation. Can you explain this greater pass-through of input costs?
Yes. So what has war done? So war has increased the prices of a lot of raw materials. It has increased the prices of metals, crude oil, petrol, diesel, and since fertilizers, natural gas, and since all these serve as inputs in various industries, so sooner or later there had to be a transmission from input cost to the final product. Now, initially, in the earlier months, what was happening was that because our consumption demand was muted, it was not picking up. Therefore, the firms or the industries were taking most of the cost pressure, the burden on themselves, and they were taking the hit. But now that we are seeing through various indicators, particularly after the receding of the Omicron wave, that a number of services and consumption related indicators are showing a pickup. So we are now seeing a pass through of, or what we say, transmission of input costs to product prices. Initially we saw only for goods, but now we are seeing for services, because services have also started picking up. They are seeing a sharp rebound after the receding of the third wave. And one of the indicators to look at that is, say, PMI services. Services sector has seen a sharp rebound in May. So that means that slowly services sector are picking up, and that gives the companies a greater power, pricing power, to pass on the input cost pressures to products.
One of the main takeaways, according to you, in the column, Radhika, is that the shift in the policy statement, the stance, withdrawal of accommodation from being committed to remain accommodated.
Correct.
It's very nuanced.
Yes. So if you look at the policy statements, particularly during the COVID times from 2020 onward, the RBI gave greater priority to mitigating the adverse impact of on growth and impact of COVID on growth, and therefore the stance of the policy was accommodative. Inflation was considered, even though inflation was on the higher side, it was considered transitory, and the main priority was given to growth by maintaining an accommodative stance. When you say accommodative, means that the RBI is giving a signal to the market, to the participants, that they will remain, they will not hike the interest rates, or they will keep the liquidity higher, so that credit can be increased in the economy. This is how they can contribute towards enhancing growth. But even if we look at February policy just before the war, accommodative stance was retained. Again, in April policy also, accommodative stance was retained, but another phrase was added, that was withdrawal of accommodation. So in other words, that the RBI wants to retain its accommodative stance, but gradually it also wants to withdraw the excess liquidity that it had infused during the pandemic time. So that was the statement in April. And that was again retained in the May policy also, which was the off-cycle policy, that they wanted to give a signal that they want to remain accommodative, but at the same time focusing on withdrawal of liquidity. But this time, the subtle change that has happened in the policy guidance is that the accommodative stance has been dropped. So it gives a signal, very clear-cut signal, that going forward, the policy priority now will change from addressing growth to managing inflation through inflationary expectations, because they very clearly talk about in their policy statement that they are very confident about growth as of now. And that is why focus is solely now on managing inflation.
At the same time, you say the RBI does not seem to be too worried about growth.
Yes.
Why do you say that?
Because if you look at their projections from what happened in May, April, the previous policies, and the main reason why this policy was watched closely was to look at their projections. And if you look at their inflation projection, in February the inflation projection was 4.5.
Yeah.
In April it was sharply raised to 5.7. And now in June, it has been raised to 6.7.
Yeah.
So there's a 1 percentage point increase in their inflation projection.
And some people think even 6.7 is not on the lower side.
It's on the lower side, yeah. And so it still underestimates the inflationary impulses. But if you look on the growth side, they haven't revised their growth projections downwards, and they give examples of many indicators that give an indication that growth is on a sound footing. So that is the reason why they are not too much worried about growth, and they are going ahead with increased interest rate hikes because they feel that growth is resilient.
But last point before we take questions from our viewers, when borrowing becomes costlier, it makes the life of government difficult because the government has to borrow to spend, and the government has a massive capex program which it announced in the budget. Finance Minister Nirmala Sitharaman announced in the budget. So how do you see the government coping with this?
Yes, so it's not just the government borrowing amount that was budgeted, that was announced in the budget. Only if you see the duty cuts and subsidies, that is going to impose additional burden on the finances. They have already penciled in 1 lakh crore extra outlay due to duty hikes, duty cuts on petrol and diesel, on fertilizers, and so on. So as of now, even with the first round of duty cuts, we see fiscal deficit getting enhanced by another 2.5 lakh crore. So that will pose a burden on the government's finances, though they expect that they will be able to recover some from the buoyant tax revenues, but there is going to be some pressure on borrowing also, and that will lead to increase in the yields, the government bond yields, and markets expect that if government borrows more, the yields will rise.
You made a point in your column about growth rates being revised downwards even further. And Aditya, who's been a member with us for a month, thank you Aditya for taking a membership, is talking about how Fitch has today revised the outlook of India from negative to stable. So that's not a bad thing. But OECD, that was a point I had forgotten to make, has made the most steeper cut, and they brought it below 7, GDP below 7 for the first time. So does Fitch revising the outlook to stable, would you take that as good news?
So it's a good news for the government because there are two things. One is the rating and the other is the outlook. And the fact that they have revised from negative to stable gives a good impression about the economy and fundamentals, and particularly for foreign investors, they look at these ratings with a great level of seriousness. So in their assessment, they feel that the fundamentals are strong, and they currently are. If you look at all the high frequency indicators, if you look at the growth rate, India is still the fastest growing large economy. So based on their assessment, they have revised it from negative to stable. But as you said, other agencies like OECD, World Bank, they have cut downward, again, primarily due to inflation. That they feel that sooner or later, inflation will start impacting growth because of its impact on consumption.
Consumption and demand. KGO, a new member, thank you for taking a membership. Simple question. Who benefits from rate hikes other than banks?
The depositors will benefit from rate hikes, and going forward, if there is a good transmission going forward, if there is control on inflation, then the economy as a whole will benefit. So rate hikes are made with this attempt to manage the inflationary expectation, because on the one hand there is a concern that inflation is primarily supply side driven. So what can RBI do to control this? But the point is that by hiking interest rates, it is anchoring the expectation. It is anchoring the inflation expectations of households. And when that happens, it's generally good for the economy. It's good for the government, because then the government's borrowing program can move at a smooth level.
I mean, to be fair to banks, KGO, we were just dissing them on home loans, but at the same time, your savings account, your fixed deposits will earn slightly more interest, and we have seen banks also doing a little bit of that, because they need to get more funds to be able to lend more, especially with RBI limits on CRR and all of that. Aditya has two more questions, but I'll come back to you, Aditya, because you've already asked one question. I'll go to Hitesh Notial, a member for 2 months. Hello, Hitesh. My question is, don't you think the recent hike in repo rate will also have a negative impact on some other sectors like MSME and real estate, which are all still recovering after COVID?
Yes, so there are going to be some repercussions on those sectors that are highly sensitive to interest rate hikes, and as you rightly pointed out, real estate sector is one of them, because real estate sector depends on loans from banks, and when personal loans will get impacted to some extent due to interest rate hikes, we should see some impact, but it won't happen. As of now, we will see some impact happening maybe in the next 2 to 3 months, another quarter or so, if we see more front-loaded aggressive rate hikes by the RBI. Because if you just see the interest rates currently, they are still lower than the pre-pandemic levels. We are still at the lower end of the interest rate cycle. So keeping all these things into account, it's not that there is going to be suddenly a very adverse impact.
Ruby, as consumption is still below the pre-pandemic level, which you just mentioned, can RBI's hike hinder the growth further?
So there are a number of things here. So if we look at RBI's rate hike, to what extent? To some extent, it won't hinder the consumption level, because markets have already priced in interest rate hikes, and they understand that to manage inflationary expectation, it's needed to increase the interest rates. Another point is that considering the impact on companies, companies' balance sheets are in a much better shape as compared to pre-pandemic, as compared to 2019, 2018. So despite increase in interest rates, they will be borrowing more. One of the variable that RBI governor mentioned in his statement was capacity utilization. So capacity utilization of corporates have picked up from 72 to 75%. So that means that going forward, immediately there won't be a very adverse impact on private sector investment. But on consumption, yes, if there are sustained interest rate hikes, then the kind of discussion that we are seeing in the US, where aggressive rate hikes could start having an impact on consumption, that will start happening here also. But again, the point I would like to make here is that we are still lower than the pre-pandemic. At least the pre-pandemic repo rate was 5.15%. We are still below, and to move to a slightly marginal real rate of interest, the RBI needs to increase the policy rate.
Anindyo Kamal Sen, again a new member, he's been with us for a month. Thank you, Anindyo. RBI did not touch CRR. So, does this go against their goal of curtailing inflation?
So, CRR is another instrument to manage liquidity. You know, what is CRR? CRR is the proportion of banks' deposits that they have to maintain with the Reserve Bank of India on a fortnightly basis. Now, only in the May policy they had increased the CRR, and banks were very much concerned that, you know, if they along with repo rate, if the CRR is also increased, then banks' capacity to lend will be impaired because a greater proportion of their deposits would have to be maintained with the Reserve Bank. So in fact, markets and banks were relieved that the CRR was not raised as of now, because, you know, liquidity is being absorbed through other options like, you know, variable rate reverse repo auctions and so on. So as of now, they have not touched the CRR and they have focused on the policy repo rate to address inflation.
Okay. Anurag Pandey is asking about something you mentioned in the column. How does the government plan to fund its deficit now that borrowing is costlier, especially with jobs and infrastructure development pressure during an election year? But Anurag, which is not an election year in India? Every year is an election year, because some state or the other will go to an election. But the question.
So there are two options. One is the government garners more revenues from taxation, which they do expect, because, you know, if you look at their budgetary projections for this financial year, they are considered to be quite conservative, and they have done quite well on their fiscal projections for the last financial year. So some amount of that deficit would be bridged by buoyant tax revenues, but there has to be borrowings, and but the government's endeavor would be to borrow what they had announced in the budget and not increase their borrowing. Though it is expected that there will be some amount of increase because they don't want to curb the capital expenditure. So capital expenditure, if it goes on, then some amount has to be borrowed, the budgetary amount, and maybe some more 1 lakh crore or 2 lakh crore extra. So borrowing has to be there to finance the deficit.
Yeah. So Aditya has 3 more questions, but I will take only 2, Aditya. With assembly elections happening in 2 states at the end of this year, do you think the government would go for another fuel tax cut? And does the government have the fiscal room to be able to do that?
So fuel tax cut would depend on the trajectory of crude oil prices. As the CEA has indicated that, you know, they will revise their, they will consider their projections of tax revenues, expenditures, whether there is room for duty cuts and all during the second half of this financial year, depending upon what happens to the crude oil prices. So they are more worried about the sustained elevation. So if the crude oil prices remain sustained at, say, more than $110 per barrel, then they will go in for another round of duty cuts. So it's not so much dependent on assembly election, because we saw in the last month's duty cuts also. We don't see it so much related with assembly election, but based on the trajectory of crude oil prices and whether it is sustained at an elevated level or it is volatile, it swings around. So those are the factors, along with the government's own fiscal balance sheet. What is their room, how much, what is the headroom to spend extra depending on their taxation. So that will guide their decision.
Correct me if I'm wrong, Radhika. I think the RBI has used 105 as the number for crude for their projections. But again, prices have gone to 120, and there is a fear that it will go further up.
Yes.
Aditya's last question, and this is the last question for the day. Why is the government still predicting growth rate of around 8.5%, even though institutions like World Bank, IMF and RBI have predicted it to be around 7.2, 7.3?
So government's projection, if you say, if you see the 8.5 percentage, was in the economic survey, and the economic survey came before the war, and so that is why their 8.5 projection. But now, if you see, I don't think now they go ahead with that kind of a projection. The CA or the government, I think now they acknowledge that there are challenges to growth, there are challenges to the fiscal policy, fiscal framework, there are challenges from the tightening cycle being done by the advanced economies. So challenges are well recognized, and these, I think the RBI's projection is much more realistic and takes into account the factors like oil price hike and disruptions due to war.
Okay. Thank you, Radhika. Thank you so much to all our viewers for tuning in and watching us. It's been a couple of very busy economic news weeks for us, and we will continue to track the news and be back with you next Friday, same time, with another episode of Macro Sutra. Until then, have a good weekend and stay safe. Thank you.